Most people believe financial crises arrive suddenly. One day, markets appear stable, institutions speak confidently, and governments reassure the public that everything is under control. Then, almost without warning, the narrative collapses and panic takes over. But history shows that this is never how financial systems actually fail. Long before markets crash, long before currencies weaken, and long before headlines acknowledge trouble, stress begins to leak quietly through specific pressure points inside the system. These early signals are rarely obvious, and they are often dismissed precisely because they do not look dramatic at first. Silver is one of those signals, not because silver predicts the future and not because it possesses any mystical qualities. Silver matters because it sits at the intersection of money, industry, and trust. It is both a monetary metal and an industrial necessity, and that dual role makes it unusually sensitive to stress inside the economic system. Recently, silver pushed toward record highs near $70 an ounce. Most commentary focused on the number itself, treating the move as just another commodity rally, but price alone is not the story. What matters far more is how silver moved, when it moved, and why it moved before many other markets reacted. According to mainstream explanations, the rally was driven by industrial demand, tightening inventories, geopolitical uncertainty, and expectations of future interest rate cuts. All of that is true, but it is incomplete because beneath the surface, something more important was happening. The mechanisms that have controlled silver prices for decades began to show visible strain, and when silver reacts before the system acknowledges stress, history suggests that something structural is shifting beneath the surface. System stress is not the same thing as collapse. It does not mean markets are about to shut down or currencies are about to disappear overnight. System stress is quieter than that. It develops slowly, often invisibly, as pressures accumulate inside the financial structure. It appears when debt levels grow so large that they require constant intervention to remain manageable, when liquidity must be injected regularly to keep markets functioning. When confidence in institutions begins to erode, not through panic, but through subtle behavioral changes. Investors hold different assets. Governments speak more carefully. Central banks become more active. During these periods, most markets remain calm on the surface. Stock indices can stay elevated. Bond markets can appear stable. Even gold, which is often viewed as a safe haven, can remain relatively controlled, but silver behaves differently. Unlike gold, which is primarily stored, silver is consumed. It is used extensively in modern industry, in solar panels, electric vehicles, medical equipment, military technology, electronics, and data infrastructure. Once silver enters these supply chains, much of it does not return to the market. At the same time, silver trades heavily through paper markets, particularly futures exchanges where vast quantities of silver are bought and sold without physical delivery ever taking place. This paper system has allowed price volatility to be managed for decades. When silver rises too quickly, margin requirements are increased. Forced liquidations follow. Prices retreat. This process worked reliably in the past. But stress builds when mechanisms that once worked smoothly begin to lose effectiveness. In December, an important test occurred. Margin requirements on silver futures were raised abruptly, a move historically used to suppress rapid price increases. Large volumes of paper silver were sold in a short period of time. Under normal conditions, this kind of forced selling would have driven prices sharply lower. Instead, the opposite happened. Physical buyers stepped in immediately. Industrial users, manufacturers, and long-term holders absorbed the selling pressure. Rather than collapsing, prices stabilized and moved higher. This response signaled something critical. Paper selling was no longer enough to overwhelm physical demand. This matters because paper markets rely on confidence. They rely on the assumption that contracts can be rolled, positions can be closed, and supply will remain available when needed. When physical demand tightens and supply is constrained, that assumption weakens. Silver's supply situation has been tightening for years. Mine production has remained largely flat. Recycling has failed to scale meaningfully. At the same time, demand from energy, technology, and defense has grown steadily. The result has been consecutive supply deficits, creating a structural imbalance that paper mechanisms struggle to manage. When suppression tactics lose effectiveness, silver does not merely rise in price. It reveals stress in the system that depends on leverage and confidence to function smoothly. Silver often moves before other markets because it cannot hide behind size or policy. Gold can be accumulated and stored. Stock markets can be supported through liquidity injections. Currencies can be defended through intervention. Silver, by contrast, must be delivered into real-world use. Its market is smaller, more constrained, and more exposed to physical reality. That makes silver faster to react when conditions change. It also makes silver more volatile, which is why it is often ignored during calm periods. Recent signals reinforce this pattern. In parts of Asia, silver traded at levels that created pricing gaps between physical markets and Western futures exchanges. These gaps matter because they indicate a disconnect between where silver is priced on paper and where it is valued physically. At the same time, large financial institutions quietly adjusted their positioning. When banks move from net short to net long positions, they are not chasing profit. They are managing risk. Such shifts suggest that stress is being acknowledged internally, even if public narratives remain calm. Historically, silver behaves this way during periods of transition. It reacts early, moves sharply, and exposes pressure long before consensus forms. It does not cause instability. It reflects it. This does not mean silver will rise in a straight line from here. Markets rarely behave that way during periods of stress. Volatility increases, pullbacks occur, conflicting narratives emerge. Noise grows louder as participants attempt to explain or dismiss movements that do not fit comfortable assumptions. And this does not mean the system collapses tomorrow. Structural change unfolds gradually. Institutions continue operating. Markets continue functioning. The surface remains calm even as underlying dynamics shift. What this moment represents is something far more important. It suggests that traditional price suppression is becoming harder to maintain. It indicates that physical demand is beginning to outweigh paper control. And it signals that trust, not broken yet, but thinning, is eroding beneath the surface. Silver is not predicting the future. It is revealing the present. It is responding to pressures that already exist inside the system, pressures created by debt, leverage, constrained supply, and declining confidence. Historically, early warnings are almost always ignored, not because they are wrong, but because they are inconvenient. They challenge prevailing narratives before there is consensus to do so. By the time silver's message becomes obvious to everyone, the adjustment is already underway. This is not financial advice. This is not a call to action. It is a signal. And throughout financial history, signals matter most before headlines catch up.